Hello, everybody, and welcome to the NASDAQ Dorsey Wright podcast this week. It is June 21st. My name is Will Gibson, and joining me this week is Sarah Maley. And Sarah, coming in this week, we actually came off a bit of market volatility. Volatility, I put in quotes if you're watching on YouTube. Last week, markets had a bit of a shakeup. The Federal Reserve came on and talked about the ways they're looking at the market right now, some of their potential policy with rates going forward, potentially raising them sooner than they originally anticipated. So you saw a bit of equity market and fixed income market volatility as a result of that last week. Also last week you had triple witching, which meant that quarterly index options, index futures, and single stock options all expired on Friday, which historically has led to higher volume, higher trading volatility as well as some of the neighboring times for that. So Sarah, a couple forces there in the market last week, making it busy from a news front, a policy front, a monetary front, even a technical front, as we saw a few of our indicators experience some movement. And before we get into maybe the meat of what we're going to talk about today, I just wanted to mention a few things last week that changed with the volatility. Following that Federal Reserve discussion, really, you saw the dollar uptick a little bit, return to a buy signal on one of its more sensitive charts. It's still in a downward trend for the time being, and we would still classify it as in a downtrend or falling dollar environment. But you did see a bit of uptick. The dollar strengthened a little bit, telling us that we have some firmer support nearby now. In addition to the dollar, we've talked about commodities multiple times on our podcast in recent weeks. And one that I did want to mention, lumber is continuing to cool off. Copper as well has continued to cool off. That's holding through this week. Volatility has been aside that as well. Copper, we did see that its monthly momentum is getting very extended. It has sold off. So maybe at the end of this month, should that roll negative as well, that wouldn't be completely unexpected given some historical numbers that we've seen. But by and large, volatility kind of trickling through as a result of a variety of things, dollar firming up a little bit, copper commodities continuing to cool off. More specifically, on our indicator front, we had some bullish percent reversals. One of our more popular and often referenced ones, the bullish percent for the New York Stock Exchange. We saw that reverse back down into O's on Friday. So that's down, sitting at a chart level of 64%. And interestingly enough, that is our 9th column change this year. And in the first half of any year, that is tying the most. And the most was from 2020 last year, which also saw 9, 2 in the first quarter, 7 in the second quarter, which makes sense. And then this year, we've seen a bit more even split, but still 9 column changes for that bullish percent in the first half of this year. And even looking back 4 years at large, so calendar year as a whole, you really don't see more than 8 reversals very often. Looking at data since 1997, there has only been 5 instances where the bullish percent for the New York Stock Exchange has changed columns more than 8 times, including this year. So the 4 other instances are 2008, 2010, 2011, and 2020, where each of those saw greater than 8 column changes. 2020 was the most we've seen since 97 with 14 column changes last year. So a ton of volatility in that regard. But maybe what's kind of interesting about that, or at least something that I found interesting about that, is that the S&P 500 in terms of drawdown this year really hasn't seen a material drawdown. It's about a 4% drawdown for the S&P this year. We did see a correction in the NASDAQ. We did see a similar pullback in volatility, or in magnitude, I'll say, in the small cap space earlier this year, but the S&P really hasn't had a big correction this year, just down 4% in terms of drawdown. And I would also add on that regard that how can that be true when you're getting so many column changes on this bullish percent indicator? That doesn't seem to add up. Reason being, I would just keep in mind is that New York Stock Exchange universe does tilt smaller in size, and it also tilts a bit more value oriented as well. And with the amount of sector rotation that we've seen this year, that would make sense that those sizes and styles, you could see some more action and volatility. So that's where we're probably attributing those column changes to. But going forward for the second half of this year, I would expect that in the indicator to cool off a little bit in terms of those column changes. But with the most recent one, we're still in high field position. That's important. We've typically seen column changes when you're in washed out territory, those coming to the upside, showing you that demand is showing signs of life. On the high side, which is what we would say now, high in higher field position, where we are on the field, we're going to say is more important, being that we're still in high field position and that we're going to keep that as a positive. We would say to maybe closely monitor some of those positions, some of those more speculative names, maybe tighten some stops there and keep things in check. But by and large, things are still holding up and remaining healthy. But really, Sarah, I think what we're really going to spend our time on today is not so much a little bit of volatility we saw last week, not the dollar, not alternatives, but a big story has been technology and the regaining of strength that we've seen there, both absolute and relative. And in addition to that, some of the growth styles that intersect technology at times or run tangent to technology at certain points. You've also seen a material rebound there after a huge run for value.
Yeah, thanks, Will. Thanks for all those great points. You're right. So we did see a little bit of change on that S&P chart, as you mentioned, fell to support at 4,170 last Friday, and this is looking at that default chart. And then with today's action, we did see the chart reverse back up, actually to 4,220. It was 4,210. It looks like it's added another X since we started recording this. So that's some news there. From here, we'd see the S&P 500 hit a new all-time high and mark a third consecutive buy signal at 4,260. So that's one to watch. We saw the NASDAQ 100 hit two new all-time highs last week, first on Monday, and then we saw it again clear another new all-time high on Thursday. The index itself did pull back slightly on Friday, but overall, that the NASDAQ 100 did hit new all-time highs, and we see that reflected on the chart of the QQQ. That chart is now also sitting at new all-time highs. And just looking at the performance of the NASDAQ 100 index itself, I just was looking through some performance numbers today, and it jumped out to me that the NASDAQ 100 is now outperforming the Dow. So at one point this year, the Dow was the best performing major market index. Right now, the NDX is up 9%. So it's a little not overperforming or outperforming, excuse me, by a significant amount at this point, but we have seen those performance numbers cross over now. And then looking at just the NASDAQ 100 index versus the S&P 500 index. So, the NASDAQ 100 index being primarily, 60% of tech, and then has a large percent of consumer cyclicals as well. But we've seen the index outperform the S&P 500 over the last 7, 30, 60, and 90-day periods. So year to date, the S&P 500 still is in the lead. But what I found interesting was that over the last 30 days, the NDX has outperformed the S&P 500 index by nearly 5%. So huge outperformance there. And then also adding to the overall weight of the evidence, I would say for the rebound of the tech sector, which we're discussing, is just over the last 7 days when we looked at the broad spider sector funds. So, looking at XLK or XLRE, XLY, things like that for our broad sector proxies, tech is the only fund that was in positive territory last week. So although it was relatively flat, but it was the only fund to not finish in negative territory for the week, which I found to be pretty astounding in itself. And then I looked at the asset class group scores page, which is where we are able to take all the ETFs, mutual funds on our system, and categorize them into over 130 plus groups. We considered the blue zone on that page to be considered the strong zone. So that's where groups have an average fund score of 4 or greater. And we did see the tech group move back into that blue sky zone, if you will, with a group score now of 4.04. This is the highest it's had since April. So I think that's relatively notable. Something else that we saw happen here was our value and growth portfolio, which is a strategy that we run using RPV and RPG. The position is always going to hold either 100% growth or 100% value. It also has the ability to own 100% cash if cash is showing outperformance relative to either of those, whichever is the winner of the relative strength chart for growth and value, that winner is then compared to cash. And as long as it's showing strength versus cash, it will be 100% RPV or 100% RPG. So right now, with Friday's action, we saw another change there. So this is, we've seen a few changes here this year, flipping just back and forth between value and growth, but that portfolio is now 100% growth once again. So RPG is that holding. We will continue to monitor that. But I think that, again, that growthy, techie kind of theme we're seeing gain some strength here. So in Dolly, tech still ranks 6th, down in the kind of lower half, but we'll continue to monitor that to see if it's able to pick up any of those long-term tally signals. So again, we haven't seen it move quite back into that area of leadership across the long-term sector rankings, but I think it is notable to see the tech group back in the blue zone, in the asset class group scores page, which has a tendency to be a little bit more sensitive, if you will, just because it's looking at, not just relative strength, it's looking at some trend analysis as well. So some absolute numbers are factored in there. But, we have also seen the gap between utilities and consumer non-cyclicals, which both rank at the very bottom of Dolly. They're now separated by 2 signals. So that's one to watch. Utilities has been ranked dead last year for a while. So that margin is now down to 2. And then something else I found notable was financials and industrials are tied with 165 signals right now. Then the gap between basic materials and energy, I mean, just the 2 through 5th, the 2nd through 5th positions in Dolly right now are just separated by a handful of signals. So we'll continue to watch that to see that battle play out. But, we're just seeing, I think, some impressive strength from certain areas. I mean, energy, we've seen that come back up. It's had this nice run from coming back from the bottom again. And I think just making sure you have those Dolly alerts set to see, if there are any future changes here. But overall, again, tech is ranked 6th. Cyclical is still ranked number 1. And, we're just going to continue to watch to see if we're able to see any long-term shifts. But right now, we're just going to continue to watch that. So, Will, I think with that, we have a webinar that we wanted to bring to everyone's attention tomorrow.
Yes, we do. Tomorrow, as Sarah mentioned, ProShares is hosting a webinar, and 2 individuals that we know are going to be on that webinar, moderated by Troy Goldstein, who's actually the executive director over at ProShares. So Tom Dorsey is going to be on that webinar tomorrow. He's going to be giving an overview of the relative strength methodology and momentum, and really what underlines and underpins a lot of what we do at Dorsey Wright at its core. So he's going to be on there, and he's co-founder of Dorsey Wright and Associates. So he's a very interesting and really fun, dynamic person to hear speak. In addition to Tom Dorsey, Jay Gragnani is going to be on there tomorrow. He's with NASDAQ Dorsey Wright as well, and he's going to highlight the NASDAQ 100 Dorsey Wright Momentum Index, which is new in its class. It's going to be talking about how it's identifying outperformance within that basket of securities. So if you're very familiar with our work on the system, I think a lot of this would be very interesting. And even if you're not familiar with a lot of our research as well, it could be a great way to get introduced and just hear from 2 seasoned people, along with those at ProShares, how this is being built out in the real world for investors. So all of those things said, we're going to keep it short today. And Sarah, thank you for coming on. Thanks for the points on technology's resilience. Most recently, that's certainly something interesting to watch and see if you could see some follow through there back to the upside. By and large, it's a tight battle for a lot of those sectors. In the middle of our ranking is still a lot of breadth in the market, plenty of room for active picks. So if we can help with that at all, you know how to reach out to us by phone, 804-320-8511, or email dwa@dorseyright.com. That's it. Thanks again, Sarah, and we hope to talk to you all soon.